Hey guys, welcome to the final lecture of this module. So it's on impact investing, which is the finance vertical of social enterprise. Throughout the last several weeks, we've learned how to create a business and drafted a business plan. And this business is a social business, meaning it will solve or contribute to the solution of a social or environmental problem. So what about the finance of this? How do companies like that grow? And then where do they get their money from? And also, how does this relate to the public capital markets, meaning stocks and bonds? We are going to ignore derivatives for the purposes of this class. So before anyone asks a question, what are the capital markets? Well, it's basically how does the commodity of money move around? And where does it go? How does it get invested? And what are some financial returns you can expect? Well, in the capital markets, there are the public capital ones, things like stocks and bonds. And for stocks, you may have heard of the stock exchanges like NASDAQ, Dow, S&P 500. Those are merely indexes. They're not exchanges, excuse me. They're indexes, which means that they are baskets of stocks put together that indicate the general level of interest or price movement of the general market. It's funny because the S&P 500 is comprised of 500 different stocks, but I think about a quarter of them are tech stocks. So even though NASDAQ is considered a tech index, when tech is up, the S&P 500 is almost always up. Today, that is. So we are going to go over this, and what does that mean? So for stocks represent shareholders' equity. They're a secondary product, meaning that on the publicly traded markets, even though you can buy a stock, when you buy a stock, you own a percentage of the company. For the most part, you have no additionality on that company. These are companies that are very, very large. In the United States, they're generally billions of dollars big. And if you buy 1,000 or 1,000,000 or even $10 million worth of this company stock, you really don't own enough of a company to be able to walk in there and say, I'd like to see some changes made. However, what you can do is you can band together with other shareholders and become active shareholders. Usually active shareholders are regarded in the media as pirates, but they don't have to be. If you believe, for instance, that a company should have more women in management roles, you can sign a petition saying that and submit that petition. If you have enough people who are behind you, you could even force a vote at the board level, which would change the governance of the public company. Remember governance from ESG, environmental, social, and governance. So just like with a social enterprise, you can evaluate a stock in the same way, because a stock represents a company. It actually represents the perceived value of a company by the mass market. So when you're trying to look at different stocks, you can say to yourself, how will I have impact? Even if I buy $1 million worth of a company, I can't really make a change. So how will I have impact? Now that's a good question. For the most part, in the public capital markets, the biggest idea is intentionality, if you want that emotional pull. However, there is another idea and there's a lot of data that shows that if you do extra research into a stock and you look at its drivers of innovation and growth, and you evaluate its risks and threats and opportunities through an ESG lens, you will, over the long term, outperform. This is because managers and companies that take ESG criteria into consideration when creating governance structures, policies, and growth plans, as well as new operations and the way they implement these things into their operations, typically are looking ahead and are looking at different risk factors and trying to mitigate them. So if you are going to evaluate a stock and look at it through the lens of ESG, so you're going to look at different metrics the company has implemented on an environmental, social, or governance level, find the ones that score the highest and create a rubric for this. For instance, what does that mean? Well, for instance, you could look at how many women are in high-ranking managerial positions. You could look at the gender pay gap. You could look at incidences of child labor. That's a big governance issue. When Nike had their big child labor scandal in 1997, the stock fell out of bed. And it took a while for the public to regain confidence in Nike and for the stock to come back up. You can also look at companies like Tesla. Tesla hasn't made any money yet. It's actually burning money hand over fist. And yet its stock price keeps going up and up and up. Now, a lot of this, in my opinion, is due to a lot of intentionality. So people feel good when they buy Tesla, but some of it is also that they are betting on the future. And their bet there's a good chance that their bet will be right. I'm not saying it probably will be right. I'm not a stock picker. I'm not a forecaster. However, what I am saying is that there's a good chance because a lot of other companies are going all electric. And electric is the future. Or so it seems, unless there's certain policy or legislative issues that get put into effect which could stop this. So we've already gone over two different ways in which you can have impact on the public stock market. The first is by being an active shareholder and trying to lobby and advocate for policies that you believe would make the company better. Or you can also be an active shareholder by sending in letters identifying risks along an ESG matrix or opportunities for a company along an ESG that get derived from environmental, social, and governance concerns. The second way we've discussed, having impact in the public capital markets, is evaluating and doing diligence on a stock with environmental, social, and government lenses. On an environmental lens, you could be looking at, is there a recycling policy? What do they do with their chemicals? Have they evaluated their supply chain, both their supply chain up, so their vendors up, as well as their clients and distribution on further down the supply chain for environmental impact? Are they stuck in an industry that caters to the whims of the past, or are they looking into the future and innovating into the future? So that's ESG. Now, a third very popular term in quote-unquote impact investing is known as SRI, which is socially responsible investing. Socially responsible investing is better known as values-based investing. It's where you take your values and you use them as filters to be able to screen out stocks. So let's say you're trying to figure out which stocks to invest in, and you look at the S&P 500. Then out of the S&P 500, you say, well, I don't want to invest in any oil stocks, any gambling stocks, anything pornography, strip club, tobacco, firearms, or gambling. Those types of companies are typically known as sin stocks. And when you screen them out, you remove a number of stocks from the potential universe through which you can pick. Depending on how strict these are called negative screens because you're screening out values that you think are negative. You can get as strict with these as you want. However, there's a lot of data that shows that if you get too strict and you screen out too many stocks, you're not going to do as well as other people would or did who did not screen them out. That's why, for instance, RBC, their impact team only focuses on ESG, whereas PAX also does ESG and SRI, and they screen out these sin stocks. It's because of this data from the negative screens that impact investing has a bad rap, and that when I sometimes mention it to people, they think I've grown long hair, I'm smoking a bunch of weed, and I'm nothing but a hippie, because they don't understand that negative screens and sin stocks are not the same as ESG valuations or shareholder activism. They also don't understand that you can have some negative screens in place and still not negatively underperform. Lastly, a better way to do screens is with positive screens. So look for companies that have policies in place or values that they espouse that match yours. So I have to ask you guys something. What do you think between SRI and ESG. In your mind, what is the balance between putting your money with your quote unquote putting your money with your values, or evaluating a company for where it is and writing a letter letting the company know where it could go? Are you willing to give up performance by having several significant negative screens? Remember, this is your money we're talking about. And that answer is personal. Please do not ever make a statement saying that someone's values are better or worse than yours when it comes to impact. Lastly, when it comes to impact, is the Ames model. And you can use this as a matrix to evaluate your investments. A is for additionality. So by investing in a company, how much additionality do you have? In the public stock market, there is very little additionality unless you become active. A note on shareholder activism. We have found, or not we, but people have found that it is only over decades that very serious change can happen with shareholder activism. I do believe this is changing because recently some of the largest money managers in the world, Vanguard and BlackRock, have started to use their shareholder status as a bludgeon for social and environmental change and advocacy. This is important because these two firms manage well over $6 trillion in assets. They are together two of the largest asset managers on the face of this planet. So when they start to vote against certain environmental policies, they carry a lot of weight. Then there is intentionality. What is the intention behind your investments? For instance, are you willing to, if you are a recovering drug addict and alcoholic, are you willing to have drugs and alcohol stocks in your portfolio? Now remember, these publicly traded stocks are secondary offerings. You have very little additionality in them, so it's purely your intentions. What about measurability? How can you directly measure the impact you are having? With these publicly traded stocks, that's a hard question to answer. And scalability. How much impact can be had by more people doing what you are doing? So for your edification, please look up the following managers if you want, and you can see how they do it. The first is Veris, Veris. Then there is Sonnen, Mirova, which is a multi-billion-dollar asset manager, Pax World, which was just bought for several $billion. The CEO is Joe Keefe. I've heard him speak. I've also, by the way, speaking of Mirova, spoken on a panel with Ken Saint-Amand, who's one of their best portfolio managers in my opinion. He's a terrific guy. Then there's Trillium Asset Management. They're great too. And Parnassus. Parnassus has unbelievable mutual funds. And a lot of small or mid-size RIAs under the range of $1 billion really, really enjoy using Parnassus funds. Everyone is getting into the game. StreetShares created an ETF, but you have to be careful because their fossil fuel free ETF actually contained Halliburton. What is an ETF? It's another type of fund that is passively held and is not managed. I briefly mentioned mutual funds when I discussed Parnassus, and mutual funds are actively managed, or so they said. So back to this ETF that was fossil fuel free. Halliburton was inside of it, and Halliburton, as you know, is an oil field services company. Do you think that ETF was truly fossil free? So we've talked a lot about stocks. Now let's talk about bonds. There is not that much activity or publicity, I'd say. There's not that much publicity around quote-unquote green bonds, but they are a thing. Typically, the World Bank or some other major multilateral financial institution creates them, and they're used to finance development on either an environmental or on a third world country basis. So we are going to look at some other things. There's Community Capital Management in Weston, Florida. They do billions. They manage billions in affordable housing credits and they do have mutual funds which you could go and invest in today. Calvert Foundation has created a private note. Well, excuse me, that's private, so we're not going to talk about it. But then there's Castleton Investment Management. That's an investment manager based out of New York City. Mike Reynoso is a good friend, and he is on senior management there. Then there's Saturna Capital. They manage a few billion in stocks and bonds. And I've met one of their portfolio managers, Patrick Drum, and he is also highly qualified. So I'm going to pause there and let you think about whether or not you have any questions when it comes to the public capital markets. I'm going to actually pause it and pick up again in a separate video for the private capital markets. Thank you. Hey guys, and welcome back to the second module of the Impact Investing Primer for your class here at Florida Atlantic University. Again, we're making this up because of the Hurricane Irma, which disrupted our schedule. So let's get back on it. The private capital markets. Yes, this is what's sexy. This is what's on Shark Tank, Dragon's Den, etc. This is where an investor gets to make a bet on you to try to grow your business exponentially. Why is that important? Because again, how can we change the world if the market doesn't want our product or service? And if it doesn't want our product or service, why would an investor want us? So when it comes to the private capital markets, they start like this. And I'm going to make it very basic. But when you're starting a company, you start first with the business plan. By now, this should be complete or almost complete. Then you go to figure out, in that business plan, you have figured out exactly what your first few years worth of cash needs are. So if you're creating a manufacturing plant and an e-commerce site, how much does it cost for the manufacturing plant? How much does it cost for the e-commerce site? How much is marketing for both? How much is staff for both? What about your fixed costs, like your rent, your computers, etc.? Once you have those figures, you can say, well, how am I going to fund this? Am I going to start really small and fund it out of profits? Is that even possible? Or am I going to fund it with my own saved up money? Or perhaps we can do a quote unquote friends and family round, which is where we call our friends and our family and we say, will you invest in our company? Usually, these people get little or concessionary returns. Sometimes, though, they may want more returns, higher returns. They may want to become active investors and help you out. Then, once you're ready to take it to the next level, you'll do your first true round of investments. This is called a seed round. People who invest in here are typically called angel investors. Now, don't be confused. An angel investor can come in at any time. They'll often be called angels because in the beginning, or when you're in a tough spot, they swoop in with a bag of money to help you. Just because they're helping you doesn't mean they don't want a fair deal. They may want very good terms for themselves. After all, it took them a lot of hard work and effort to earn that money. After your seed round, you will work for a little bit, and then you'll start fundraising for your A round. This is called the Series A. By this point in time, you will probably be profitable, maybe doing $1 million in revenue or more, and ready to fundraise some more. I mentioned the $1 million in revenue because I know several venture capitalists who will not invest in Series A rounds unless the company has done at least $1 million in revenue. Also, to qualify for the Small Business Administration loans, which come at very good terms, you have to be doing a couple million in revenue. So, then from Series A you do Series B, then you do Series C, Series D, etc. And on it goes. In today's world, these private investment rounds can go on ad infinitum. But historically, after a certain point, private investors wouldn't want to invest in you because they'd say, well, you go public. We shouldn't be the only ones bearing the brunt of this. So that's when a company undergoes what's called an initial public offering, or IPO. During this stage, the company will do a massive fundraiser, usually 9-10 figure range, sometimes 11 or 12, 11 figures even,
and major institutional investors and large-scale allocators will invest in it. After they're done investing in it, the shares will go public, which means that the general market or even non-accredited investors can invest. Non-accredited means that people have a net worth of less than 1 million or a joint net income, I believe, of less than 200,000, I believe. And that's important because so basically the IPO was kind of like the final fundraiser. Now there is something called a PIPE, which is I think it's a private investment in a public equities, which means that a company might sell off a little bit of its shares to a private investor, but that we're going to ignore that for the purposes of this class. What is important to note is that the IPO market, compared to 10 years ago or 20 years ago, is seeing many fewer IPOs because a lot of these private companies are staying private, quote unquote, forever. Look at Uber, look at Lyft, look at Instagram. Well, I guess Instagram is now owned by Facebook, so that doesn't count because Facebook is a public company. But a lot of these companies are staying private. An interesting phenomenon is that some of these tech companies, like Snapchat, which had a multi-billion-dollar IPO, ended up being valued. Its value went down after the IPO over the long term, which tells you that the private market had been frothy, meaning that the private capital markets were valuing companies too highly based upon news and excitement and quote-unquote sexiness. For you as an entrepreneur, that's a good thing because that means that perhaps your company will be valued at more than it's worth. So if you ever go to sell some shares, if you get dividends based upon your equity compensation, you will be getting paid more than perhaps you would be if you were a public company. So be grateful for that. Now, investors can invest in your company through two ways, equity or debt. And you should consult a financial advisor or consultant before issuing any type of term sheet and entering into any type of deal of that nature. You want to make sure that everyone is protected. You want to go over what's called share dilution, which means that if future investors get in, how does that affect your ownership of the company and your previous investors' ownership? Are they going to be diluted on a pro rata basis? Or are they not going to be diluted at all, meaning that they are kind of like super shareholders? Also, equity comes with the right to vote and to have some say on governance. Are you issuing shares that have no voting rights? Think about these things and consult a professional before you enter into a deal. Now, when you go to an investor, when it comes time to sign the contract, that quote-unquote contract is often referred to as a term sheet. Sometimes a term sheet can come before a contract, but for our intents and purposes, we're going to call the term sheet and the contract the same thing. This term sheet will have various, stipulations and policies and whatnot on it. But as a social enterprise, you have to ask yourself, are you going to memorialize your social or environmental mission into the terms of this deal? So that way your investors can never say, why are you treating people so well? Or why are you trying to help the environment? I want you to make me money. Let's get out of the solar business and get into the oil business. And you can look at them and say, listen, we signed a contract. It was in the terms of the agreement that we're going to do solar. We're not going to do oil. Sorry, buddy. This could also be put into your bylaws of the company if you have a public benefit corporation, which we mentioned at the beginning of the session. Now, who are some big examples of this? Well, there's Calvert, which also has Calvert Foundation, not to be confused with Calvert Investment Management, but Calvert Foundation. They have private notes as well as public mutual funds, which they allow people to get involved in social and economic development. There is the Rise Fund, which is perhaps the biggest name out there right now, and the sexiest name, because U2 lead singer Bono is their spokesman. It's a multi-billion-dollar fund put out by TPG. They have made some very large investments in education companies and other types of companies across the globe. There is Keen Growth Capital, which is based in the Orlando area.
Jonathan Smiga spoke for us at the launch of the Florida Impact Investing Initiative. I forgot to mention earlier in the public capital markets section that Alyssa Greenspan, the president of Community Capital Management, also spoke for us at the launch of the Florida Impact Investing Initiative. And Eddie Ogston also spoke at the launch of the Florida Impact Investing Initiative. He is based in Miami. Now, Keen Growth Capital is a very interesting impact company because they are about a $40 million venture capital fund that invests in better-for-you products. So imagine a shelf-stable breast milk that has been proven in clinical studies to reduce the amount of time a baby needs to stay in the NICU. Think about how useful this was after Hurricane Harvey, when the hospitals went down and these premature babies had nowhere to go and very few people to take care of them. Another firm I'd like to mention is Newwood Capital, run by my friend Ainsley Cohen out of Washington, D.C. Newwood invests in bottom-of-the-pyramid payment platforms. I recently referred her a deal from my friend who I went to college with that is a payment company, actually a collateralized loan making company out of Uganda, and they make microloans to entrepreneurs in Uganda. They have special technology that allows them to approve someone for a loan in less than a day, and the average loan size is $2,000. They're currently raising $1 million in equity and $5 million in debt. Now think about that. They're going to be raising approximately $6 million in. So think about it. How many loans will they have to fund with $6 million in cash that they're fundraising? The answer is about 3,000. So they need to find 3,000 people in Uganda who are creditworthy to give loans to. And then once they make a profit off that, which is significant because microfinance has good margins, they then need to find more people and more people. Think about the scale and the complexity required in doing a project like this. Could you find 3,000 people and then screen all of them for credit risk and figure out a heuristic statistical analysis, an algorithm to be able to base future acceptances off of? Do the math in your head. Next is Acumen, which we did discuss and we watched some videos on. Acumen is a nonprofit that invests in both for-profit and nonprofit social enterprises. So I would call them venture philanthropists. They are using the venture capital model to further their social mission. You can also look at the Chan Zuckerberg Initiative, which is a foundation. However, it has taken a for-profit structure. Several nonprofits or mission-based funders are getting into venture capital and private equity. What is the difference between venture capital and private equity? Private equity is for later stage companies. It can also include other asset classes, such as traditional real estate. Speaking of real estate, I am hosting a series of speakers and lunches across the country, all focused on how real estate can heal the world and your bottom line. Some topics we're going to mention are energy retrofits, different types of management, different innovative construction materials, such as upcycled concrete, as well as new innovations in design and architecture. Imagine a building that breathes, or a building that recycles all of the water that's used in it, or a building with motion detecting light sensors. The last venture capital company or advisory firm that I'm going to mention is Align Capital out of California, run by my friend Jennifer Kenning. They have very good work. Now we're going to take a pause for questions. And I want to address one more thing before we completely pause on this venture capital stage, which is that venture capital is becoming quite a big deal. I mean, it's on TV. You see Robert Herjavec on Shark Tank doing a lot of mission-based investments and environmentally based and socially based investments. You see a lot of other spin-offs doing the same thing. I was recently approached about doing a climate finance TV show. So this is not something to sneer at. It's very important. It's becoming very big. It's very sexy. The biggest banks are getting into it on both the public capital markets and private capital markets level. And I highly recommend that you do some research into some of these companies I mentioned, so that way you can understand what's being funded. I also recommend you look into it in case you want to take your business plan and turn it into a real company, because these are people who will be able to help you. Maybe not in your seed round, but definitely in your A or B round. Not everyone always invests in the seed because, like I said before, that is when you are very risky. You have not yet proven yourself, and you have not yet gained revenues. The more revenues you get, the more market share you capture, the less risky you are in the eyes of an investor. So with that, we're going to say enough with the public-private capital markets, and we're going to get in the next module into public-private partnerships. Thank you. So public-private partnerships are very easy to describe, and we're not going to go into too much detail, but I think it's very important that you understand some of the basic things that are happening and who some of the major players are. The idea is the public and the private investment world will work together. What do I mean by the public investment world? Well, governments have money, a lot of it. They tax us, and they tax, and they tax. And then they have to put that tax money to work for our benefit. That's part of the social contract. And so nowadays, they are working with private companies and private individuals and institutions for the betterment of humanity as a whole. Think about a project like affordable housing or certain types of construction work, and now they're doing work in medical fields. And the idea is that you get paid for success. So look that term up, pay for success. In the US, that is synonymous with social impact bond. In the United States, a social impact bond is the same thing as a pay for success project. It is not a bond floated out there, by a company. It is a pay for success project. And pay for success is exactly what it sounds like. There are pre-agreed upon metrics, and if the project results in those metrics, the government will refund the private investors their money plus a return. Goldman Sachs did one of the first ones in the United States trying to work on prisoners at Rikers Island. They're trying to help these prisoners lower their recidivism rate. The issue is that in the United States, these pay-for-success projects have to be very static. And if you run into a problem during the project, for instance, you find out that your therapy for the prisoners isn't working, you're not allowed to change it to find out a new methodology that would work. Therefore, in the United States, it can be very hard to have a pay-for-success project actually be completed successfully. In the UK, however, you can change your methodology midstream and have success. After all, isn't that what trying to achieve the greater good is for? Unfortunately, the way the U.S. government awards contracts, it just doesn't jive with the basic underlying thing in pay for success. Who were some players in pay for success? I would look at Social Finance. Social Finance is a very innovative company, and they do a lot of pay for success projects. They're pretty big in the United States, and I would call them market leaders. Thank you. Hey guys, so we're at the final end, or almost the final end, last one of two sections in this impact investing module. And this section is devoted entirely to who the major players are, because I want to give you a very summarized selection of them. Well, there are these very large financial institutions like Morgan Stanley, Goldman Sachs, BlackRock, but for the most part, these guys are just kind of tiptoeing into it. The last time I did my research, BlackRock, which is a multi-trillion-dollar company, had only I think 20 or 25 million in their impact investment fund. So relatively nothing. I mean, 20 million, you can't do much with that in the financial world. Morgan Stanley I think has about 6 billion in assets, maybe a little more, a little less, but again compared to 2 trillion, What does that mean? And also, how many of those assets are intentionally an impact, and how many of those were just invested in companies because they made good business sense? Which, to my mind, is not an issue. I think that if it's in impact, it's a good thing, doesn't matter. But a lot of these assets were in these companies prior to them ever even knowing that they were impact companies, quote unquote. Then there are some mid-size allocators, and these are like family offices that are $1 billion, $2 billion in size. Maybe some in the $10 billion range, some in the $500 million range. There are foundations all in that range too, in the 9-figure to couple $billion range. Ford, when it comes to foundations, has been the market leader. They pledged $1 billion of their $14 billion endowment into being deployed into impact investments. That's a big deal, especially from a public relations standpoint. Now, other foundations that are market leaders are the Kresge Foundation, which has a $300 or $400 million endowment, $300 or $400 million in impact. The Rockefeller Foundation, which is doing a lot of innovative stuff, both on the grant side and the for-profit corpus investing side. CZI, which we've mentioned, the Chan Zuckerberg Initiative, and the Bill and Melinda Gates Foundation. These are all vanguards and trailblazers in the foundation world. In terms of other investors, the smaller investment managers and registered investment advisors as a whole are just getting into it. Many of them are still trying to grapple with the idea of the DOL's fiduciary rule, which states that you need to trade or buy or sell stocks and bonds based on your client's best interest. Historically, finance has not ever been or taken into consideration their client's best interest. A lot of mutual funds like the 12B, extra had at 12B fees and whatnot, and that's because the brokers or the investment manager got paid more. So this DOL rule has had a lot of pushback. Trump issued a 180-day injunction staying it. The DOL just issued a 60-day injunction staying it. So let's see what happens. But there are people, and I've attended conferences just for these smaller or mid-sized investment managers, under, let's say, $500 million in AUM, who are getting into it mainly through mutual funds because they don't have the staff or the inclination to sit there and figure out their own, SRI or ESG metrics. Now, some other endowments are getting involved. Universities and pensions are getting involved, especially after the new changes to the DOL rule that I mentioned. This is really big in the EU and is starting to become big in the United States. Part of the issue with universities in particular is there aren't as many options for them to invest in. So there's an idea called divest invest, which means you should divest out of companies who have values, who espouse or push values that you don't believe in. Typically, this is related to climate change, but has been used to boycott nation states and entire religions. And I'm not going to get into that right now. I will later. But so the students will say, we want you out of all fossil fuel-related companies. We want you to divest your holdings out of Exxon, Shell, Royal Dutch, whatever. Royal Dutch Shell, excuse me. And we want you to get into, better for you companies. And the university managers look at them and say, listen, these companies give great dividends. They help us match our liabilities. The dividends pay for the lights, pay for our janitors, whatever. We don't want to divest, but we will start to divest because you are the students and we are here to serve you. And not every university believes that, but the ones that do say it that way. And they say, or in a similar manner. And so they divest a portion because they can't just take out, let's say, $1 billion or however much is in Exxon or other oil stocks and invest into solar. There just aren't that many solar options available or wind options. So they divest on a schedule. Maybe every year they'll divest X percent. For our sake, let's call it 10%, which is not a real number. I'm taking that out of thin air. And they take 10% out of Exxon and they spread it across, many other companies. And then they have to come up with their own ESG principles. Are they going to do SRI? Are they going to do limited SRI, meaning only a couple negative screens like fossil fuels and tobacco, firearms, and gambling stocks? And that's what they have to do. Another major player that I'd like you to look up is Jed Emerson. He created the idea of the triple bottom line, which is people, planet, and profit. Triple bottom line. We already mentioned social finance because they're big players in the pay for success model. There's RSF social finance, which will help you create a donor advised fund. So will Impact Assets, big names. There's a U.S. Impact Investing Alliance run by Fran Siegel. She and I have both spoken at conferences together. She's a rock star. I'm quite a fanboy and a huge geek and admirer of hers. There's John Morris, who is the chief investor behind the Social Capital Markets Summit called SOCAP, which I will be at this October. And we sat down a few months ago and discussed, our backgrounds and stories and our visions. Then there's something called the Impact, which is trying to engage next-gen family members and current decision makers in these large families, very wealthy families, to get into impact. This was founded by Justin Rockefeller, Kevin and Elizabeth Phillips, Josh Cohen, and Liesl Pritzker Simmons, and her husband Ian. It is run by Abigail Noble, and is quite a powerful organization because they represent billions of dollars in wealth. Now, I did mention earlier that Vanguard and BlackRock have been getting involved in shareholder activism, especially with regards to environmental advocacy. There were some landslide votes earlier in the year, and you can look them up. And this was a huge phenomenon that rocked, the investment world, because BlackRock and Vanguard had never before, voted along environmental lines in such a publicly publicized manner. Lastly, some of the biggest players, or potentially biggest players, are foundations. And I'm going to teach you a little bit about foundations right now. The way a foundation works is that a wealthy individual will create a charitable organization called a foundation. It's very similar to a donor-advised fund, but donor-advised funds are typically smaller and they're actually more modern. Foundations are a relic of the past, but they're quite impressive and carry a lot of heft and weight. And some of the biggest names in American history, like the Carnegies, the Rockefellers, etc., the Fords, have all created foundations. The way it works is the endowment has 100% of the assets. 5% of those assets need to be given out to charitable causes every year, no strings attached. These are called grants. Now, this is of particular importance to a fundee because these grants have no strings, so they're the most valuable type of money ever. There are different theories on what a foundation should do with this 5%. A lot of people believe it should be there as a first loss mechanism to support the poorest and to support initiatives that couldn't get off the ground otherwise and to de-risk it. And we'll get into that in a second because that begins to get into blended finance. Then the other 95% of the corpus, or the endowment, is invested in a for-profit manner. Historically, this was done in a very conservative manner because people had interpreted the Department of Labor ruling of fiduciary responsibility very strictly. Everyone was very scared of being sued for taking quote-unquote too much risk. But remember, earlier in the session, I discussed ESG due diligence as a method of risk mitigation. And now people are starting to see that. So you've got 95% of the foundation being used to generate income and 5% being used to give out. Plus there are salaries and fees. So in order to really be able to just break even, a foundation would probably have to earn 7 to 8, 9%, which is a very high rate because the best money managers average about 8, 9%. And I mean the best. I mean there's a few people who do more, but most of the people do way less. As such, it doesn't really make sense to have a small foundation. For instance, if you want to do something new called a program-related investment, which is where you make an investment in something that directly relates to your programming, but counts towards your grant bucket, so towards that 5% bucket, I was told by an expert that it doesn't make sense to do a PRI if you have less than $3 million in assets, just because of all the legal and advisory fees that go into this. Then there's something called an MRI, and an MRI is a mission-related investment, which is typically referred to, there's two buckets. One is values-based investing, which we discussed, and that's for aligning your public capital markets portfolio with your values. And then there is, again, the mission-related investments in the private capital markets. So that would be a foundation making a grant into a nonprofit or a for-profit social enterprise. Typically, for a rate of return that is better than a PRI. The PRI might have a good rate of return, but again, it comes out of the grant bucket. So if nothing happens, nothing happens. It's true first loss capital, but with the caveat of being able to have a little bit of return. So think about it. Before, your 5% was earning you nothing, whereas now your 5% can earn you something. Even if on average, let's say it only earns you 3%, that's a huge boost. I mean, that's a big, big boost. And these terms are relatively new, having been created at the end of 2015, so not even 2 years old yet, or about 2 years old. And there are only a few people that specialize in them. Earlier I mentioned Align Capital. They're very good. There's Richard Marker from NYU, but he also teaches at UPenn with some of the other people at their School for Philanthropy there, High Impact Philanthropy. I highly recommend them, especially if you or someone else owns a foundation. Go take their class. I'll give you the referral, and they'd be happy to teach you. Then there's Bree Triptych out of Canada, who does a lot of work with foundations, and she's a philanthropic advisor. There's Terry Maru, based here in Broward County, who is terrific. All of these people I'd be happy to make introductions to. I did forget to mention earlier in the public capital markets section, my friends at Cornerstone Capital. Erica Karp, the former director of research at UBS, created her own impact investing company. They do a lot in the public capital markets, some in the private capital markets, and they're really terrific. I've sat down with Erica and her whole team. I mean, they really get it. Now, to jump back just a second to a couple other ecosystem partners I think you should know. The first is in the news section. So look up Impact Alpha. They are a terrific news organization. They send out a summary every day of what's going on in the deal flow sector. I mean, they're at every conference. They've really taken the corner when it comes to impact investing. And there's TriplePundit.com. My friend Nick Astor is the founder, recently sold to 3BL Media. They do really good work in the sustainability space. There's Bloomberg Sustainable Finance. The GIIN, G-I-I-N, Global Impact Investing Network also has some news that they put out. Tonic does TONIIC. And these are all great organizations I suggest you get plugged into as soon as possible if this is something you want to pursue and have the time to read. In terms of foundations, I'd like to make one last recommendation. Please look up the Central Florida Foundation. They're based in Orlando. My friend Mark Brewer is the executive director, and they have launched an accelerator. And they are really pioneering the way when it comes to social enterprise in the Southeast region. So with that, I hope you really enjoyed your impact investing primer. If you have any questions, I'd be happy to look it up. And I don't want you to forget that when it comes to impact investing, you really have to not only follow your hearts, but make sure that there's a lot of metrics and data and key performance indicators behind your decisions. Without data, it's just a lot of emotion. And if there's one thing we know about investing, it's that emotions can make you sell at the bottom and get in at the top. So consumer finance and behavioral finance and the psychology of finance is very important when it comes to investing. And please seek counsel from a professional financial professional before getting involved. Thank you very much and have a great rest of your week.